Okay, we should be recording now as we speak. So good morning again, and I'm going to say good afternoon again to everyone. Thank you so much for coming to this very informative session. Expatriate tax issues for Canadians in Dubai. Our sponsors and our friends and members make these videos and webinars possible. And of course, Towbridge, why Towbridge is there, and they've always got your back. So I want to say hello to Ernie and to Wayne from Towbridge. They're out in Ontario as we speak. Am I correct?
Well, I'm in Mexico now.
Yeah. I'm in Cayman.
Okay.
But yeah, we won't mention that.
And Ernie's in Cayman, but
okay, never mind.
From
that was
Ontario.
my bad. But
Yeah.
nonetheless, okay,
Yeah.
nonetheless. So again, once again, we're lovely to have all the possibilities of having everybody be able to be on one platform so we can discuss these matters. So again, welcome to everyone. Thank you, our sponsors. They've got some hands and chats going up there. Please remember that if you want to write some more questions, we've had your questions sent in. Please write them in the chat box. At the end, we'll try to make sure we get them to you answered right away. And if not, can I be able to forward the questions to you, gentlemen, so that we'll be able to get in contact with these people directly?
Sure,
I don't want to take any more of your time, but I want everyone to know that we are pushing full steam ahead. Thank goodness we have something called the Connect groups, and the Connect groups are basically sector specific groups. So we have more of a tight knit group, which we have our legal teams, we have our medical professionals, we have our women in business. You'll be seeing that all in the emails coming up. Make sure you're part of that. And we're probably going to need a lot of advice from Towbridge on this. So I will let you gentlemen do your magic, and thank you very much. Talk to you later.
Okay. Well, thanks again to the CBC for having me. This is the 15th year in a row, actually, that we've done this presentation. The first year that it hasn't been in person. So I'm really hoping that by the end of the year, things will open up and I can get there to keep the streak going in person. So, but as Diana mentioned, so we really specialize in international tax. For Canadians living around the world. So my specialty is the international personal side. Ernie works on the global mobility team, which is when companies move individuals around the world. He helps the employees and the employers make sure everything's done right. But we also have a US group. We do a lot of US taxes and payroll and accounting and corporate tax. So really anything related to tax. We have offices in various cities around the world, about 100 employees now, and we've been going for 18 years, which is amazing how quickly time flies. So there's a lot of slides, and I'm just going to touch on things briefly here and there. Some slides I won't go over in much detail, just more for information. But I'm going to talk about residency and whether you're a Canadian resident or a non-resident for tax purposes. And there's been a lot of different issues this year with as it relates to COVID and people spending more time in Canada. We'll talk about whether you have a principal residence in Canada as well, and whether you're selling it or you're renting it or you're looking to buy. And Ernie will touch on that. And to touch on like a departure tax return, which is just a return to make sure you've gotten out of the system properly, because it is really important to make sure you've done that part properly. And then we'll talk about fixing up returns and then returning to Canada, which some people have probably done this year, or people are thinking about a lot more now as well, with just everything going on. So it'll be an exciting start to your evenings. I'll also talk about some things that have been happening outside of COVID and just other things to be aware of over the last few years. And one of them is that the CRA, like a lot of the governments around the world, especially now, are needing to raise tax money. So they're looking at individuals that have assets around the world. So when you're back in Canada, if you have assets around the world, it's important to ensure that you're reporting them and you're including them. And the CRA spent, I think, $450 million hiring individuals to kind of look after this and look into people with assets abroad. So this is more like if you return to Canada and you have your assets abroad. So it's just something to think about. We haven't seen any actual results yet, so I don't know how well they're doing, but you know, it's just something to be aware of. One that I always love joking about is the whistleblower program, which is something that the CRA came up with. And what happened is there's an individual in Switzerland who gave away all tax information to the IRS. And it allowed the IRS to collect 300 million of extra tax revenue. And that person got a 30% bonus. So they got about 100 million in income, which was taxed, obviously. So it wasn't as good. But so then the CRA came up with a program as well. So for any individuals, for Canadians that are abroad that are not declaring income or assets, there's actually a program where you can call in and you can get a bonus of up to 15% of the tax collected. So it's just, it is something to be aware of. The actual joke is that 2/3 of the people that called the whistleblower program were disgruntled ex-spouses. So I guess make sure you're nice to your ex-spouse if you've done anything wrong. One other thing is that the CRA now also gets transfers of $10,000 or more. So when you transfer $10,000 to Canada, the CRA gets a copy of it. So it used to always go through anti-money laundering and anti-terrorism checks, but now the CRA also gets copies of it. So again, I always say, you know, I don't recommend sending $9,999. And you know, if you're not doing anything wrong, you're legally working abroad, there really isn't a problem. I know a lot of times people get worried about this, but it shouldn't be a problem. As for those that have properties or looking at buying properties, there's sort of the foreign buyers tax in Vancouver and Toronto for people looking to buy properties if they're living abroad. This tax is a bit of a misnomer because they call it a foreign buyers tax, but if you're a Canadian citizen or a Canadian permanent resident, even if you're living abroad, the tax doesn't apply to you. So it's not really a non-resident tax per se. It's more a non-citizen, non-permanent resident. So, but if you are looking at buying properties, then these are some of the things you want to continue. Sort of the Vancouver speculation tax and empty home tax. I think this is just part of the process of trying to control the cost of rent and that people aren't leaving empty homes in Toronto, Vancouver, and certain other places in the GTA. One other thing that I really want to mention is the CRA delays. So if anyone's been dealing with the CRA, things are just taking forever now, especially in the international space. So you have an international tax issue, it can take a long time to get responses from them. They moved a lot of their agents over the last year to help out with kind of CERB, and a lot of the local issues, which further delayed things. So we get that all the time from clients that are asking where there were filings, where there are notice of assessments. So it can take a long time. So it's just something to be aware of. There was a lot of government incentives earlier this year, and who knows what's going to happen. I won't go into them, but hopefully the people that were eligible for this and resided in Canada did claim all the government incentives through the CERB and things like that related to COVID. So this is a slide that I always put up, especially I really like doing work with people in the UAE and the Gulf region because there's such a big difference. You know, if you're helping someone go to Europe, the tax rate there could be super high as well. Whereas, you know, in the UAE, it's either zero personal tax or you pay Canadian tax rates. And you can see, you know, once you hit sort of 200,000 in Ontario, you can be being paid 53.5%. So sometimes people look at this and think, wow, it's, you know, I love Canada, I want to go there, but do I really want to start paying high tax rates again? So, and so the reason I like to do the tax rates is because it leads into what's the really important part of this. It's, you know, if you're a tax resident if you're a resident for tax purposes, which is different than citizenship, then you're taxed on your worldwide income. And so that's why when we have clients who come on or we're helping people, it's really important to ensure that your residency status for tax purposes is cleared out, is clean, because as you can see, on $100,000 a year salary, and a lot of the benefits, like if you're getting housing or anything like that paid for, those are taxable benefits as well. So your salary can go up quite a bit. If you're non-resident, you pay zero tax, but if you're resident of Canada, you'd be paying $27,000. On 200K, you'd be paying $73,000 a year, and you can see how that adds up over 3 years. So even if you're living abroad and you're working in Dubai, if you have enough ties to Canada, you can still be taxed on your worldwide income. And that's why, again, it's really important to ensure your residency for tax purposes is taken care of. And this year, as we'll get into a little bit later, it's been really interesting and challenging as people have moved back or spent more time in Canada because of COVID than they expected to, or maybe one spouse was able to leave and another wasn't. So I'll talk a bit further about that. But really, from a residency perspective, Canada looks at it from kind of your primary, what are your major ties? And one is, did you leave your home in Canada vacant? It's all right to rent it out or to sell it, but if you leave it vacant, then it's going to be looked at as a major tie to Canada. Are your spouse and children in Canada? Those are major ties. And then also, do you have a job available for you when you go back to Canada? So those are some of the big ties. And if you have any of these, it gets harder to become a non-resident. Not always the case, and we always look at ways around it, but those are really the big ties. And then there's a whole host of secondary ties. Do you have bank accounts? Do you have credit cards? Do you have professional memberships? Have you kept your health care? What about your driver's license? And you're probably fine having one or two of these. If you have a rental property and you keep a bank account and a credit card to help with that, you're fine. But we typically recommend, minimizing these ties so that the chances of you being seen as a resident are a lot lower. And when we do our tax consultations, we go through a lot of these ties in details and recommend which ones to try to eliminate and which ones might be all right. There's also a form called the NR73. That is a form that the CRA puts out, and they call it a determination of residency status. So if you want to Google that, we recommend never actually filing that form, because you're allowed to determine your own residency. And so, we recommend not filing it unless it's requested by the CRA. There's a few tricky questions on that form. So you really just want to be careful when you're looking at that. So one that is going to come up, and I'll talk a bit more, is there's also a sojourner rule. So if you spend more than 183 days in Canada in a year, you're seen to be sojourning in Canada. And even if you don't have factual ties, you're taxed in Canada on your worldwide income for the entire year. And so this is something that we see, we've seen a lot more this year. Fortunately, there's been some rules that allow it, but in normal general years too, if you're going to spend more than 183 days, that's an important thing to make sure you don't cross over that amount of time in Canada. So there's also the Canada-UAE tax treaty. So a lot of times people will say, well, there's a tax treaty between Canada and the UAE, and the treaty normally overrides domestic law. So if you're a resident of the UAE, you'd be a non-resident of Canada. However, what happens is this treaty, I don't think it's this one and the Kuwait treaty weren't written very well, in my opinion, because to qualify for the residency benefits under the treaty, you have to be an Emirati. So a lot of times for Canadians that go over, they can't qualify under the treaty. And that's why it's important to make sure you're following domestic law and cutting as many ties as possible. So in terms of becoming a non-resident, the key way of doing it, and the way you have to do it, is actually you file something called a departure tax return. And that's really the tax return that gets you out of the Canadian system. Now, I won't get into too much detail on it, but basically there's a box on the front page that says, did you enter or leave Canada? And you have to ensure that box is filled out to allow that allows a CRA to know you're filing as a non-resident status. What we see often is people just file a normal tax return the year they leave, and then they just stop filing. And so until you've actually informed them through the filing of this tax return, then you're still seen as a resident for tax purposes, and you're taxed on your worldwide income, which again is something that that no one wants when they can pay zero tax instead of 53% potentially. And again, I won't go too much into it, but there's special forms that only go with this filing. There's a T1161 if you have more than $25,000 of assets. And if you don't file that form, there's penalties of $2,500 per person. So it's just important to ensure you do the proper and the final tax return properly so that there's no issues going forward. So what was actually somewhat impressive was that the CRA provided guidance on some of the issues that Canadians were facing because of COVID restrictions. So again, one of the things that happened is, people came back in March and then they couldn't return to certain countries because, they weren't allowed in, because they weren't citizens, and because of COVID restrictions. So then all of a sudden, you would pass over 183 days and, potentially be considered a resident of Canada for tax purposes under the sojourner rules. So the CRA actually said days of presence from March 16th to September 30th wouldn't count for these rules. So that really made things a little bit easier and eased a lot of concerns about potential sojourning in Canada and people being stuck in Canada. And we've had conversations where one spouse has been in Canada and the other isn't. And so there's been a whole host of issues related to that. And so I just thought I'd go through a few case examples in case anyone listening falls under that have been sort of related to COVID. And we've been able to do things a little bit differently this year with regards to treating people as non-residents of Canada or delaying the time when they become a resident of Canada if they move back because of some of the COVID issues. So as I mentioned in the first case, the days in Canada, so say you came back in March and you couldn't get back out until October, November, those days would not be counted towards the sojourner rules. So as long as your intention when you first came to Canada in early March, when they were telling Canadians to return, was to go back, then we can treat you as a non-resident even if you're still in Canada. Now there's a whole host of other issues around that, but it's just something to consider. Then also, what happens if you went back in March because of the thing, and then all of a sudden you lost your job and you had to stay? Now, normally we would say, okay, you became a resident when you go back in March, but what if you had planned to go back and then you couldn't because you lost your job in June or July? Is there an argument to delay the time when you became a resident of Canada again, which could be beneficial? We had one instance as well where, and this was actually in Qatar, where someone moved and their spouse and children were going to come later. And we had planned on, they were going to stay resident of Canada until the spouse and child joined them. And they'd gone through all the steps for everything to happen. And then, kind of COVID happened and they couldn't get in, the spouse and child. So then we looked at it and we said, okay, the real intention was that the child and spouse were supposed to go. They did everything, and then things just changed that were beyond the control of the spouse and child. And so we looked at treating the one spouse in Qatar as a non-resident, even though the spouse and child are in Canada, which is something that we normally wouldn't do. But again, it was just a very specific and different situation. Again, what if you moved to the UAE and you weren't there for very long, and then you had to move back because of COVID and you lost your job? Could you be a non-resident even if you were only there for a short period? And then we might look at that situation and say, well, your intention was to stay abroad, but things happened and you couldn't. So again, there's so many different specific situations that you want to ensure you look at if you follow them. All right, Ernie, you want to hop in now?
Sure, thanks, Wayne. So ownership of property in Canada is obviously a large area that a lot of expats look to. Usually people are in a situation where either they have a home prior to departing and they decide whether they want to maintain that home, sell it to a third party or rent it out. That's one example. The other example is where we've got expats that live and work abroad, and maybe they choose not to purchase a home in the country that they're living in. Maybe they're not going to stay indefinitely, so they decide to buy in Canada. We see that a lot because of the Canadian currency difference and the fact that property in Canada is still relatively affordable in comparison to some international cities. The key aspect of this is ownership of property typically would not impact your residency status as long as you don't leave the property vacant. So back to what Wayne was covering earlier, where we were talking a little bit about the tax treaty and the importance of ensuring that you sever residential ties in Canada. One important one is obviously the home, and renting it to a third party and ensuring that you meet the filing and the reporting obligations relating to the property is very important. If you plan to rent it or sell it, there are important filings, and I'm going to just cover them briefly now. Now, Wayne, if you could flip the slide, unless I can do it. Oh, there he is. He's my slide guy. Okay, so Canadian rental property. So if you own a property in Canada as a non-resident, there is an annual reporting on a form called an NR4. That's where you report the gross rental income and the withholding on that rental income. You have two options. You can follow the gross method basis, which is 25% of the rental income that would be withheld and reported on the slip, or the net method basis, which is 25% of the net income on the property. Now, that's purely just for the income reporting slip, very similar to when you get a T4 slip. We then have you file what's called a non-resident tax return at the end of the year. And what that does is it basically reports your actual income and expenses, and you then get taxed on the net income. Generally, it's in the range of around 22%. So you would then be refunded the difference between what was withheld and what your actual tax rate is. One thing to note is if you do file the net method basis, the NR6 method, you do have to have a Canadian agent in Canada that does registers the property and becomes your agent for purposes of the withholdings. Our firm is registered as non-resident withholding agent. So if any of you are in this situation where you do need to do some reporting, we have a group in our firm that just handles rental property matters for expatriates. So you're welcome to get in touch with Wayne and I, and we can refer you on to our team. Next slide, Wayne. Sale of property, another very important one. If you sell your property as a non-resident, it's important that you file something called a clearance certificate. That's typically done with the accountant. So that's something our office does do, or the lawyer. It's important that it's done properly because there's a calculation that's done as part of the withholding. It's basically a 25% withholding on the gross proceeds initially, and with the certificate, you remit on a net basis, so on the estimated gain. If it is not done properly, there are severe penalties as well as penalties for not having the withholding done. Generally, if the lawyer will prefer that the accounting firm does it so that the calculations are done properly. So it's again something we can help you with. And then you must file a non-resident Canadian return at the end of the year to report the sale. So something to be aware of. I get lots of clients saying, well, I was in a loss position on the sale of the house. Do I still have to meet these requirements? You still do. You still also have to file the non-resident return, even if you have a capital loss. So just be aware of this requirement. Otherwise, there's a hefty $2,500 penalty per taxpayer. So if husband and wife own a property, both spouses in that case, if they didn't meet the requirement, would be hit with the penalty. So a total of $5,000 plus interest on that. So it can be quite hefty if you do get hit with the penalty. Next slide. I'll let Wayne, you take over this one.
Okay, so this is something that we do quite often, and we call it amending prior year returns. So a lot of times, as I think I mentioned, someone might have left Canada and they just now realize they didn't actually do a departure tax return. They just filed a normal tax return and left. You can actually go back and amend that tax return to make it a departure tax return so that you can be seen as a non-resident of Canada. Also, sometimes people will continue to pay taxes in Canada, even though they should have been a non-resident. And you can go back potentially up to 10 years under the Fairness Program to get taxes back that you may have paid when you shouldn't have. So if you kept filing because you had bad advice or you didn't do a departure tax return, then please feel free to get in touch with us, and we're happy to hopefully get some money back from other years, or to at least get you properly out of the Canadian tax system. So there's also a voluntary disclosure program that people can take advantage of. If you have done something wrong and you're facing potential penalties, sort of not reporting your foreign income, if when you're a resident of Canada, there could be penalties for you and a spouse of up to $5,000. If you didn't do a departure tax return properly, there could be other penalties of potentially $5,000 as well. So there is a program before you go and correct things that you can go through called the Voluntary Disclosure Program. And what happens is in that situation, the CRA will waive the penalties. So if you owe any tax, you're still going to have to pay the tax. But if there's any penalties, then as long as you qualify, then they'll waive the penalties. And a lot of this is they really just want people to comply. So that's sort of how you can do it. So if you have done anything wrong or you want to correct something, then potentially look at the Voluntary Disclosure Program as a way of doing it. There's something I'll quickly touch on, and that's granny trust planning. So if you're going to move back to Canada and you have, say parents or a brother or someone, and you're going to inherit money from them, instead of them giving you the money directly, if they put it into a trust for you, you can receive the income tax-free. So for example, your parents are living in the UAE, and they want to give you, say $1 million when they pass away. If you earned money on that $1 million in Canada, say, 50,000, a 5% return, you might end up paying around 25,000 in tax in Canada. But if it goes through a trust and then gets paid out the next year, that's completely tax-free. So it really depends on certain circumstances. For example, again, parents or brother and sister have to be living outside of Canada and not be expecting to move back. But if that is the situation, I just wanted to mention that because there's not much really good tax planning that can be done. But if you're in this situation, you're expecting to inherit money, then you'll want to look at this as an option to really reduce your tax in the future. All right, so the year of arrival back in Canada and just planning for your arrival. So the key thing is that once you land back in Canada, you're going to be taxed on your worldwide income from that day forward. So if you come back, June 30th, any income you earn anywhere in the world from that day onwards is going to be taxable. So if you keep a rental property in Dubai and you're renting it out, any income from the day you move back is going to be taxable. If you receive any bonuses or end of severance payments or end of service payments or severance or anything like that, it's important to ensure you get everything received before you move back, because any receipts of this type of income, if you're back in Canada, can be taxed at Canadian tax rates. So a lot of times some of the end of service payments might be quite big. So just make sure that you're getting any type of bonuses or anything paid out before you go back. And if need be, maybe delay the time you go back to Canada. If you are keeping any assets abroad, if it's more than $100,000, and you have to report it on this special form, the T1135. And then you have to declare the income earned on these assets as well. And there's a penalty of $2,500 per person for not doing this. So again, it's not a problem to keep assets abroad. If you have them, you just really need to make sure you declare them. One other question that always comes up is, how is the transfer of cash taxed? So because tax is already considered kind of tax paid money, you can transfer cash to Canada at any point tax-free. So if you have $100,000, you can transfer $50,000 back before you become a resident again, and you transfer $50,000 afterwards. You don't have to worry about that being taxed. It's only income on gains. And again, say you had $100,000 in an investment account, and from June 1st to the end of the year, it earned $5,000 of income. It's only that $5,000 that is taxed. You're not taxed on the actual full balance of the assets that you have, which is always a big concern for people. And again, this year is going to be a little bit more interesting, for people that might have moved back in June or even say March pre-COVID and thought they were going to go back to Canada, but then or back to the UAE, but then it didn't end up going back. So trying to figure out when exactly they became a resident of Canada again. And the way you turn this into an arrival return is there's a box on the front page again that says, did you enter or leave Canada? So on the way out, you have to indicate, that you left Canada on a certain date. And on the way back in, you will indicate the day you enter. And that's, again, how you let Canada know you're back in the system and how you're a resident of Canada for tax purposes. If you are with your spouse, it is important to make sure, if one doesn't go back early to potentially trigger residency for the other spouse if the other spouse is working. So there are some issues to look after and to plan. We typically recommend 3 to 6 months beforehand of just having a call, just to go through everything. Ernie, you good?
Yep. All right. Thanks, Wayne. So I just want to cover a couple topics just on global mobility. As Wayne mentioned before, I deal a lot with employers that relocate employees around the world. What was interesting with COVID is we went through this period of time since around March of 2020, where there was kind of a combination of people on their own as employees of foreign companies or Canadian companies for that matter, deciding to live and work where they felt safer. So they might have gone, from Canada to, let's say, the UAE or UAE to Canada to be with family without really contemplating what some of the tax and payroll implications could be to them and to their employer. The other scenario is where we've seen employers allow foreign employees to relocate themselves, again, where they feel is safe. And we've gotten a lot of queries from companies saying, oh gosh, what should we do now? We sent our employee, or our employee voluntarily went to another country, and we're not really sure of what those requirements are. So back to what Wayne was referring to earlier, I'll just go through a couple examples just to kind of make this a little bit easier. So the first one is, let's say you've got a UAE resident, visits Canada, but needs to remain in Canada due to the travel restrictions. Very similar to what Wayne was saying, we might be okay from a residency perspective because that period of time during COVID is considered disregarded for purposes of evaluating the 183-day test. Where we get into complexities is if, let's say, that employee is now working in Canada for the UAE employer, technically that employee would have non-resident requirements from a payroll perspective. So that foreign company, let's say in the UAE, would now have to report in Canada payroll for that individual, as well as set up a business number if they don't already have a Canadian operation. So it definitely brings about complexity. So even though the individual might not be seen as a resident for tax purposes, they could be subject to tax in Canada as a non-resident because they're actually performing the service, even if they happen to be doing it from their parents' living room. Unfortunately, that could then be seen as their place of doing work. So it could be seen as taxable. Another example is UAE resident who usually works less than 180 days in Canada is now stuck due to travel restrictions. again, we get back into, yes, maybe that period of time is disregarded. We might also get into looking at what point could the person be seen as a resident, but even determination of residency, we could be in a situation where some of those days could be subject to tax, and we've got to meet those requirements in Canada. Next slide. I think we now go back to Wayne. So yeah, just to recap, that really is just, some of the things that we've got to look at from a employee-employer perspective. So important to really have a conversation probably with us and your employer before you decide, A, where are you going to stay long-term, and B, where are you going to perform your service, especially if you go to either Canada or a country that does administer income tax for employment services. It's important to know. So I'll let Wayne just wrap up here on this last slide.
All right, so here's the slide that we put in to say, like I said, we presented in the UAE for 15 years in a row now. It's a real big specialty that we have, ensuring everything is done properly. So I like to think we give peace of mind. But so what we try to do is we often try to speak with people before they leave, just to make sure they've taken all of their all the steps to be seen as a non-resident of Canada. But we can also speak with people after they've left as well to clean things up, to make sure there's no issues going forward. And then we do all sorts of Canadian tax returns, so we can help with the arrival return to get you back in, the departure return, and as Ernie mentioned, non-resident tax returns as well for rental properties. And then we do planning on the way back in, U.S. tax returns if need be. And so, anything really related to the expat sort of life. Now that we've been doing it for so long, we've had people leave, come back, leave again. So we've helped a lot of people over the years. So definitely happy to help. So I think, Heba, do we want to start, Diana, do we want to start with the Q&A?
Hi there. Can you guys hear me now?
Yes.
I'm back. Okay. Actually, I was never away, to tell you the truth. So let's just put it that way.
Okay.
Actually, so we do have quite a few questions already. I mean, I have tons, but I cannot, we have to share the wealth, as they say here. Okay, we've got a question there. It says, hi, is there any period of time where the CRA cannot claim on any unpaid taxes? i.e., I've been out of the country for 10 years. That's an example.
So the answer is it depends, which is often the answer in tax. So there's something called sort of statute barred. So after 3 years, if there wasn't any fraud or anything like that, then the CRA can't go back to kind of come after you. But they have this provision where if they believe there was fraud, then they can open up and go back. What we've typically seen is anything if you've been out of the country for more than 10 years, even if you didn't file a departure tax return, there's also that 10-year fairness. Then we would say, if you haven't been approached, then don't worry about it. Especially if you didn't mean to, you just didn't realize. 'Cause a lot of times people just didn't know. So I guess, again, the answer is it depends. But anything before under 10 years, you may want to go back and correct it and just make sure you get yourself out of the system. So.
Yeah, that sounds like really good advice. Okay, so we've got another, it's quite similar, but I'm going to read it anyway, just out of fairness. It says, hello, my husband and I have been in Dubai for 14 years. We never did the departure tax return. We have a bank account, but no driving license or health card. What should we do? And can we buy property? I'm assuming buying property in Canada. Sorry, I'm just assuming here. If our panelist, our attendee wants to write if it was in Canada that you want to buy the property, that would help. Okay.
Okay. So again, if it's been 14 years, I wouldn't worry about going and correcting anything. And this is just a general answer. And it sounds like that person doesn't have many ties to Canada if there's just a bank account. And then it comes down to the property.
Yeah, they
Uh,
wrote yes in Canada. They do want to buy the property in Canada. Yes. Okay.
And then whether it'll be a vacation property or they're going to rent it out. If they're going to rent it out, then it wouldn't be a problem because it wouldn't be considered available for their use. If they're going to leave it empty, then technically it's a tie to Canada, which could be a little bit risky. If it's just a
Yeah.
vacation property that they're going to use in the summer and they've been away for 14 years, I really haven't seen the CRA come after people, but it can be considered a tie. So, that's one that
we've got so far rented out. Okay.
Okay. So if it's rented out, then yeah, then that wouldn't be a problem at all. Just make sure you do all the rental filings that are needed, and then it should be fine.
And then too, there was another mention too. They're obviously rented out. They're as non-residents in Ontario and the GTA area. We are no longer Airbnb-ing. We're not allowed to as non-residents, right? So just remember that too. So make sure that when you understand renting it out is a different type of renting out for the time being. Okay. We have a lovely other question. Sorry, how do mortgage applications work for non-residents? And is there anything I should watch out from a tax perspective?
That's an interesting question. So I can't remember the rule, if it's 30% or 35%. There is a bigger amount that you have to put down as a non-resident. And on the application, I think sometimes what people can do is if they indicate they want to come back to Canada, that could be problematic if CRA ever look at it. But sometimes people worry about, declaring their full income or anything like that. I wouldn't worry about it. If you're a non-resident, you've done everything legitimately, I wouldn't worry about declaring anything to them. And I've never actually seen the CRA request information on our mortgage document either.
Okay. And the same person here says, plus, is there any harm renewing my driver's license as a non-resident?
So technically, you're not supposed to now because you're not living there. I would say 90% of the people in the region probably do renew it. Is it really considered a tie to Canada? It's a lot lower down level than something like health coverage, because it's not really a cost to the government if you have a driver's license. I think the technical answer is no. If you don't have a lot of ties, then we see people do it all the time. So
I guess it makes it's like a Linus blanket, makes them feel better. I don't know why. Okay. And then
I think a lot of it comes down to people not wanting to have to do that. We had a client who came back, and I can't remember where it was, but he had to do the G license. He was like 60 years old and he couldn't couldn't drive at night or something like that.
Yeah, that is a bigger reason for sure. Okay. And then says, if we're not residents and we've been out of the country for 15 years, filing also taxes on a yearly basis for everything I have in Canada. Okay, so this person, they've been out of the country for 15 years and they filed their taxes for the whole time for everything they have in Canada. If my family goes back this year, would I be considered a resident if my family are back, but I'm not?
So the first thing is, so they probably shouldn't have been filing tax returns to report the Canadian income unless it was rental income. But any other income should have been subject to non-resident withholdings. So they may want to look. They may want to look into that and have someone look at it to make sure the filings have been done properly.
Yeah, they just wrote back, yes, it was rental income. Okay.
Okay, so that's perfect. So then that's exactly what should have been done. So that's not a problem.
But just go ahead.
Then,
sorry.
Typically, if the spouse and say children go back and you stay in Canada, then typically we would see you as a resident of Canada as well, because you're availing, your family is availing themselves of all the benefits of Canada, but no tax would be paid. So typically depends. There's various situations where this might not be the case. Like if one spouse goes back because they have a really sick parent, or there's other reasons, then it might be different. But typically, if the family goes back and one stays abroad, then we would see them as residents. So that's something you'd want to take a much deeper look at.
Yes, I think it sounds like a very personalized level. This. So do you know, there's another, we've got another few questions, and it says, do you know if Canada will in the near future introduce a wealth tax?
I would have said probably no. And I still think I would say no, but now there's this whole COVID thing has created a lot of debt in Canada. I don't think so, though. I still think anytime other countries have done wealth taxes, I don't think it's worked out as well as they had thought. So, and I think the Canadian tax rate is high enough that I think if they started doing things like that it would not go over well. And there's been no mention anywhere. The CRA, when they're going to do things, they give sort of heads up, I would say, about that. And I haven't seen anything. Ernie, I don't know if you have any different thoughts, but.
Oh, yeah, I haven't seen it yet. I think there's still, we're still going to be in a wait and see as to what happens in terms of what the government administers in terms of tax. I think the overlying theme is probably tax rates will obviously go up. Depending on, if we look at what changes they made for 2020, they'll definitely target kind of the higher income earners and then probably have them pay a larger portion of tax to help with COVID funding. But I guess we'll have to wait and see what happens.
Okay, fair enough. Yeah, thanks, guys. Yeah, like I think we're all on a wait and see a bit for everything, right? Yeah. Okay, we have, how does the CRA know when you return? Is it based on the honor system, or do they check you with immigration to see when you arrive?
So right now, Canada works on the kind of honor system. So you file a tax return and they may question or they may not. And you indicate the day you came back. We haven't seen CRA match it to immigration issues, although we have seen them like EI. We had someone who had EI and they were in Dubai, actually, I think it was. And because, they had the electronic entry system when it said when, and they were able to track the person that shouldn't have been claiming EI through that system. So.
Yeah, well, exactly. And they are like, there have been, I've heard some people that had actually came for whatever, because they had a sick parent, and then they came to the Emirates, and then they ended up themselves being quarantined for COVID. So they were stuck. They weren't able to go back. So thus making it more complicated. So there is ways of finding when you're there. We have another question. It says, are there any implications subscribing into GICs as a non-resident?
I would say typically no. I mean, I guess it would depend on a lot on what your other ties were as well, but typically no. I don't think the CRA has gone over people that are, putting money into Canada, investing money into Canada in GICs or anything like that. A lot of times it doesn't necessarily mean you want to go back to Canada or you have intention to go back to Canada. It could be you just want to put your money somewhere safe. So, and any interest earned because you're a non-resident, interest income is not taxable to non-residents. So there wouldn't actually be any tax on that interest income either. So, I wouldn't, again, it could be very specific to the case, but I wouldn't say there's an issue with investing in GICs in Canada.
Okay. We have a question. Does it make a huge difference if I have health insurance in Canada from my Canadian employer, and this person has been living here 8 years?
That could be seen as a minor tie to Canada. But in general, if they've been here for 8 years, unless they have, family in Canada and like that, then they're likely would be able to be seen as a non-resident anyway. I don't know if Ernie has any thoughts because he does more global mobility, but this just could be the Canadian employer didn't realize that they shouldn't have been doing that. Yeah. And I don't think it shows any intention to go back to Canada. It's just, the Canadian employer might not have.
Yeah, I agree.
Yeah. Oh, yeah. Oh, exactly. We have one more question, then we have actually a couple of comments, which are great. If you are a permanent resident, well, sorry, actually I have a few people that sent it on the phone here, so I'm sorry, there's a couple more questions. We actually have, let's go back here. Well, most of that you answered. Can I possess the driver's license? Okay. If I want to access my last tax return and if the government owes me any money or vice versa, how can that be done?
So there's a number where you can call the CRA. And then you can also, if you still have a Canadian bank account, you can access a lot of your CRA information through CRA My Account. So if you Google My Account, that'll show up. You might need a code at some point, but there's a lot of ways of being able to do it electronically, or just having to call the CRA.
Yeah, exactly. I think you can get it from, personally, I go through my CRA account through my bank account. So you were able to go in that direction.
Yeah,
but,
there's a lot of information there now, and they're geting better and better at being able to provide things electronically.
Right. All right. 2 more questions, and then it says, okay, if you are a permanent resident, immigration status due to Canadian spouse. Okay, so you're a permanent resident because your spouse is Canadian and both living outside of Canada. Is the permanent residence considered a non-resident for tax purposes?
So this is a very good question. And CRA actually put in one of their folios, they actually mentioned this. So getting permanent residency status clearly shows sort of intention of living in Canada and wanting to go to Canada. But they've said, as long as you don't acquire a lot of other ties, like you don't apply for health insurance, you don't, start getting driver's licenses and have a home available for your use, and buy a car or things like that, then you can still be seen as a non-resident. But you definitely want to make sure you're really keeping your ties minimal to Canada if you have permanent resident status.
Okay, that makes sense. Another question. I have an RRSP and the institution sent me a tax form showing the contribution. Do I need to do anything with it?
So one, do you know if that person just left Canada in 2020?
I think they just went to visit, not to live there. They're permanent residents here.
Okay, then typically what you wouldn't want to do is you wouldn't want to be contributing to an RSP. And the reason is when you put the money in, if you're not a resident of Canada for tax purposes, you're not getting a deduction. But when you pull the money out, it's going to be taxed at a 25% non-resident tax rate. So that's why we typically tell non-residents, don't contribute to an RSP, unless you're filing a return in Canada for whatever reason. So,
okay, so that makes sense. Okay.
They might want to stop doing that. Or again, if they did leave in 2020, then they could have still taken a deduction for any contributions up to March 1st of 2021. So.
Again, I think the best answer that I would give personally, contact Trowbridge personally and make sure that we're guiding you correctly. So we actually, it's not a question, but a comment. It says, I've been with Trowbridge for a couple of years. Great service. And Wayne is very accessible for consultations. Thanks, from Ahmed. So thank you.
Right.
And Darmish as well. Here it says, great presentation, so useful. Thank you for CBC for organizing. Well, thank you, Trowbridge, for being the meat. We are just the potatoes. You guys are the meat, okay?
Yeah, love it.
And what else? Sorry, the RSPs have been there for 14 years and have not been contributed. So that's fine. Okay.
So maybe it's just a summary. So then the person can leave the money there, or if they want to, and it'll still continue to grow tax-free, or if they pull it out, there's a 25% non-resident withholding.
Yes. Okay. Well, there you go. And of course, one of your favorite clients, Al, has said, "Hey, you didn't tell the story about your grandmother." Now we're going to have to tell the story about your grandmother because either I don't remember it or a lot of these lucky people haven't heard it. So
That's
it's up to
hilarious.
you. You play that by ear.
I've only
I
heard
don't
it
know.
12 times.
Yeah, right. Let's save that for the next one because we want to make sure that everyone is going to get a good grandmother story out of this.
Oh my God.
Okay.
I love that Al always comes to the events and he always gives me the gears, I guess you'd say, at some point or other during the presentation. So that's why I kind of miss doing it in person. So
Oh,
thanks
we
for
miss you. We miss you too. We miss both of you. We miss everything, but we do miss you.
glad Al got in.
Yeah. What one other question is that what other types of investments can non-residents make in Canada? Like, can they anything like I don't know, like anything other than property? Let's put it that way.
So I still kind of think that you can invest in anything in Canada, and I don't consider it to be really a tie because I don't think Canada wants people to stop investing. So if you have you don't want to put money into RSPs and you can put it into RESPs. And if you're a non-resident, you 100% don't want to do anything into a TFSA because there's penalties of contributing to all these accounts. But if you have a non-registered account, say, you want to invest in Bank of Montreal or Bell, interestingly enough, capital gains are not taxed to non-residents. So, if you buy the shares of Bell for $10 and you sell them for $15, the $5 gain is not taxed. Whereas the dividends would be taxed at 25%. So,
Okay. Yeah, someone said here mutual funds. They put as a question mark. Mutual funds.
You can invest in mutual funds, and whatever income it earns, there'll be non-resident withholding. So if there's dividends or whatever is paid out of them, trust income, then there'll be non-resident withholding tax. So you need to make sure that they know you're not living in Canada. But otherwise, I don't see it as being a problem. It's just sometimes it's harder to invest with certain advisors in Canada for people living in the UAE because certain banks don't want to deal with any of the risks.
No, fair enough. Ernie, excuse me. My question to you: do you find that people are non-residents are going to be wanting to invest in property in Canada? So they're going to be looking for more of your guidance at the moment?
Definitely, yeah. So, I think we always see ownership of property in Canada becoming a hot topic. I think with people contemplating whether they'll either work in Canada in the future and maybe work for their foreign employer remotely or potentially move back in the future, people are definitely looking for property. So we have seen a lot of movement in that area. So I think it'll continue to go that way. Just, you're always going to have in times of crisis. I think we saw this back in 2008 where you have movement into Canada, but you also have movement out of Canada. So I think there's always something happening. So it'll be an interesting year to see, interesting probably a couple of years to see what happens in 2021 and 2022 in kind of the world employment market, especially with people being able to work from home more than ever before, as well as ownership of property.
Fantastic. Well, so thank you so much, gentlemen. I can't thank you enough. I think the actual question people are asking is why didn't they contact you earlier? But the whole thing here for sure is they can contact you now. I want to thank you very much. Q&A, I just read that now. So sorry, I like the A as in the Canadian A, the Q&A. Sorry, it takes a few minutes, but I do get to the punch. Okay. So thank you so much, gentlemen. You have obviously made a lot of people much calmer. They really, it was very informative. And so we will make sure we'll get your contact information out to everyone. And with your permission, we will put the whole webinar online because, again, we are here to share information. So we want to make sure everyone has what they need. I'm sorry, my screen is doing a little bit of tricks today, but you actually get to see our wonderful mission and vision statement. But we know that CBC has your back and so does Towbridge. So thank you so much, gentlemen. Enjoy your time and stay safe. And I can't wait to see you both soon. Take
Okay.
care.
Thanks,
Bye-bye.
guys, everyone.
Thanks to
Thanks so
everyone.
much.
Thanks
Thanks,
to
everyone.
the team as well. Thanks, CBC Dubai. Bye-bye.
Thank you. Bye-bye.